We're in Denver, Colorado at Enercom's 19th annual Oil and Gas Conference. I have the pleasure of welcoming Alan Bay, the President and CEO of Rock Energy. Good morning.
Good morning.
Now, Rock Energy was previously focused on heavy oil, but today you are a medium and light oil producer. You reported that production is up. Can you tell us about your areas of operation and where your production growth is coming from?
Absolutely. We have two main core areas of operation. One of them is what we call Mantario, and it's producing from a lower formation of the Manville. And it's a very prolific formation, high porosity, high permeability. We have one asset that actually produces about 3,500 barrels per day. We're in the process of implementing an EOR scheme at that asset. In other words, to get enhanced oil recovery so we can increase the recovery factors. We'll be developing an asset that actually produces about 3,500 barrels a day flat for about 3 or 4 years. So it's going to be a very solid foundation of production and cash flow for the company. We're right in the late stages of developing that asset. We should have that fully operational by the end of this year, early next year. The other main asset we have is up in an area called Onward. It's about 50 miles north of Mantario. And up at Onward, we have two main plays going up. The one's a shallow Viking light oil resource play. So in other words, what we do there is we have about 40 sections or about 20,000 acres of land up there, net at 100% working interest, where we're drilling horizontal multi-stage fractured oil wells. We've developed an inventory so far that's about 200 to 300 wells deep, and we think that by the time we finish developing that asset, we'll have about 500 drilling locations. Production from that asset currently is only about 300 barrels a day, but by the end of the year it should be about 1,000, and by the end of the first quarter it should be about 1,500 barrels per day of light oil.
Alan, in your investor presentation, your first slide says, "We are exploring in an area we can afford to be in." What does that statement mean?
Yeah, good point. Now, one of the things we did at Rock is about 3 years ago, we really took the company from the deep basin of Canada into a more shallow area, which is down in the near the Alberta, Saskatchewan, U.S. border. What happens is the horizons now are only about 3,000 feet deep. So for us to test an exploration concept, and we do this with about 8 to 10 exploration wells per year at least, it only costs us about $500,000. So for about $5 million, I can test 10 ideas, versus up in an area like we were in the deep basin, it would take $5 million to test one idea. So we're in an area now where Rock is an exploration and production company, but an area that we can afford to be so that we can afford to accommodate the risk that's associated with the exploration program.
Can you talk about your CapEx budget and how you plan to fund your drilling program?
Yeah, we just recently increased our capital program from $90 million to $110 million. So just recently announced that last week, in fact. That extra $20 million is essentially coming from incremental cash flow that we're generating because of our production growth and also expanded debt facilities. Now, Rock currently runs a very low debt level. We're only about $16 million of debt, and we have operating bank lines of $80 million. But even with that expanded capital program, our year-end debt's only forecast to be about $55 million, again, against our bank lines of 80, and that's only going to be about 0.6 times our forward cash flow. So again, well within our covenants and well within our comfort.
Your company is doing a lot of work to improve recoveries. Could you talk about the results you're seeing?
Yeah, as I mentioned earlier, one of the main assets we have is at Mantario, and we're implementing an EOR scheme. And what we're doing there, under primary production, what you would get is about 10% of the oil in place would come out through the wells. When you pressurize the reservoir with water, you could do what we call a water flood, and you get maybe 15%, so you add about 5. But what we're going to be doing there is implementing an EOR scheme, which is a polymer flood. And what we do with polymer, we essentially thicken the water. When we thicken the water, what we do is we change the relative viscosity between the oil and the water, and we actually allow the water to more efficiently sweep the oil from the injector to the producer. That takes our recovery factor up to 25%. So that's a very significant increase from the original 10. And that's what allows us to, in this case, capture 10 million barrels of recoverable oil from a 40 million barrel pool.
Alan, what are you better today at than you were, say, 10, 20 years ago?
Yeah, that's a really interesting question. You think back 20 years ago and where I was with my career, and I think where I'm at, one of the things that I've discovered is the value of talent. And one of the things that I think I'm better at today is identifying, recruiting, and retaining and mentoring talent. And we, at our team at Rock is very focused on building leadership skills with our executives. And that's allowing us, I think, to build the team of the future and allowing us to build, resilience into our organization. So I spend a lot of time, and my senior executives do, building the talent within our organization, and we're very focused on that.
What else would you like our viewers to know about Rock Energy?
Well, I think the thing that's remarkable about Rock is in the last 3 years, we've really transformed the company from a gas-focused company to an oil-focused company. We've also moved it from a heavier oil company to a much more lighter, medium gravity crude. And that's really translated into our netbacks. If you look at our last quarter netback on an operating barrel was over $48 a barrel. That time last year was only 30. And that really changed the face of the company. And what that means is we move forward into 2015 and 2016, you're going to see our cash flow per share grow very significantly. In the last 3 years, we've been growing our cash flow per share by over 100% per year. We're on track to continue to do that as we move into 2015 and 2016. And the market's just discovering the kind of cash flow impact that we can have. And I think that's what we've done is transform the company.
Well, Alan, it's been a pleasure to have you. We really appreciate your time.
Great, thank you.
Thank you. I'm Quinn Nguyen for oilandgas360.com.